there are a couple of interesting and potentially underappreciated countervailing forces at play. First, on the negative side. In the early part of the pandemic, the combination of fiscal stimulus payments and a lack of opportunity to consume, given the shutdown of services and limitations on the availability of goods, you had US consumers that built up roughly $2 trillion in excess savings and paid down $2 to $300 billion worth of credit card debt. By most accounts, consumers, at least those apart from the highest earners, have depleted those savings and have added back to credit cards to bring levels to those that were at or above 2019 levels, even adjusted for inflation. Based on our $27 trillion economy and consumer spending that represents a bit over two-thirds of that, that 2.3 trillion that was effectively recirculated back into the economy when spread out over the year and a half in which it was, that could have added around 8% or so to total consumer spending over and above what you would consider to be the consumer's ongoing capacity to spend, which is not an inconsequential sum when looking at things from a year-over-year growth perspective going forward. Now, the employment market remains very healthy, keeping consumers engaged in the economy. Wages are growing, which does provide some capacity going forward. But that excess spending coming from the excess savings having been spent and a releveraging of consumer balance sheets on cards does not appear repeatable, which does dampen the outlook somewhat.